Yep, all of a sudden we have 10.
Right. Welcome to those of you who've logged on. We'll be starting in about a minute. We still have many people taking their places, and we'll be with you in just a moment. I believe that if you have questions during the webinar, there is a window for you to enter them, and then we'll see them and go through the questions and address them at the end of the webinar. We'll have about 10 minutes at the end where Scott and I will entertain questions. Okay, we've got a solid number of people on, and it's 11 o'clock, so we'll get started. Welcome to today's webinar, How Simon Demystifies Indexes in Structured Annuities. And my name is Kerry Pechter. I'm the host of the webinar and the publisher of Retirement Income Journal. My guest is the esteemed Scott Stolz, who I've known for many years. He's been in the annuity and the annuity distribution business for many years. Welcome, Scott.
Thank you, Kerry. Thanks for having me.
Many of you may know Scott from his years as a insurance executive, and as Scott is now the head of insurance solutions at Simon. He was head of insurance solutions at Raymond James for quite a while. And it's interesting, Scott, you kind of brought annuities with you over from the manufacturer area to the broker-dealer area, and now you're bringing it online to the platform area. So I can see a interesting progression here. But if you know Scott, I know that you know how much he knows about annuities and this industry, and we'll have a lot to talk about. Just to give you a little bit of context, every June, Retirement Income Journal runs 4 consecutive issues about on some aspect of indexed annuities. And that's because this is a product category that has emerged as the strongest one in the annuity industry in the last couple of years. And this year, we've also added a couple of webinars, and we'll have 2 webinars this month. We're looking, this year's focus within the index annuity space is the indexes themselves, because these indexes have proliferated. There's now some 140 indexes, many of them hybrid indexes or volatility controlled indexes that are available inside either fixed indexed annuities or registered index linked annuities. And these have created a world of choices and flexibility and functionality for advisors, and to use these products in new ways and to get new kinds of exposure to different sectors of the marketplace. But with this added functionality has come a great deal of complexity, because advisors now have to pick they have to pick a carrier, they have to pick a product, they have to pick a crediting method within, and they have to pick indexes that they want to give their clients exposure to. And there are a lot of moving parts in here, and it's hard to see cause and effect. It's not just like buying directly a index fund like the S&P 500. You now have exposure to an index that has an index of indexes, or an index that rebalances daily, or something like that. So Scott and I are here today because about a year and a half ago, I was writing an article about Simon, and they told me at the time that they had a secret capability to analyze the indexes and educate advisors about the best ways to use them, how to allocate them, to explain them, and how to allocate their clients' premium to the indexes inside the annuities. And this is really now where the rubber meets the road, and that's why Scott is here today. And I think that it's going to be we're going to take a deep dive into the indexes and into what Simon does. But we'll just get started by asking Scott exactly what Simon is.
So Simon is actually started out of Goldman Sachs, and it was a platform that we built in order to help individuals who sold structured investments. And if you participate in the structured investment space, you realize that a lot of the challenges that exist within structured investments also exist within the annuity space. They're complex products, they're highly regulated, they come with training requirements. The data is kind of all over the place. It's not the easiest business for advisors to do. Goldman Sachs understood that, so they began to build Simon as a means to support and better market their own structured investments. They subsequently spun it off to the industry because the feedback they got from many of the distributors was, this is a great tool, but we really need this tool for all of our structured investments, not just the Goldman Sachs ones. And so that's what caused them to make it an industry platform with that almost all of these structured investment issuers use. In fact, somewhere between 40 and 50% of all the structured investments sold in the country now flow through Simon. Once they built out the structured investment side, then we started on the annuity space because, like I said, it is very similar. Prudential was one of the initial investors after it was spun off, and they saw the benefits of using Simon and its capabilities on the annuity space, particularly in the areas that you've talked about, Kerry. And so that's what we're about. What we're creating is a place and a platform that an advisor can use and go to for all of their annuity business to better manage it, as opposed to having to go to one system for this and another system for that, and then come out of that one to enter the order. And really, there is no good way for an advisor to look at all of their annuity book of business. And so Simon is, the goal is to solve all of that for the advisors.
Mm-hmm. That's it. And what are we looking at? This is one of the slides from the Simon
Yes.
website, and this talks about this addresses the kinds of products that are available on the platform. What is that range of products?
So when you go to the Simon system, this is the first page that you will see. And these are the three products that we cover today: structured investments, annuities, and we recently added defined outcome ETFs. So the advisor would come to this page, decide, figure out which of these three investment categories that they're going to utilize Simon for, and then they just simply click on the blue button and off they go.
Mm-hmm. And is this geared for individual advisors or for enterprises particularly?
It's mostly about giving the support that the individual advisors need, but there is functionality for the back office of the distributors as well, to give them better insight into their entire book of business, what their advisors are doing, what their advisors are selling and not selling, and to view all of their products there as well. So it's really designed first and foremost for the individual advisor, but it's an extremely useful tool for the back office.
Mm-hmm. And you said that you said that these folks are investors. That's a little bit unusual in this space. I'm used to dealing with platforms as tech startups that then go into the industry to solicit companies to bring their products onto the platform. But this has all these heavyweight banks. And why are these folks invested in the platform?
So they all saw that this industry had this common need, and that as popular as structured investments were starting to become, it was very difficult to do without more technology. And as opposed to everybody going their own route and trying to develop their own technology support, thereby creating a new problem, which is, all right, so I have to use this system if I want to sell Goldman. I have to use this system if I want to sell Barclays. I actually have to give the industry great credit for coming together and realize that, hey, let's just have one platform that we all can use and all operate from. And the best way to do that was for all of them to become the initial owners in the spinoff.
Mm. Now, these companies, let's see, well, we have Prudential is the only insurance company there right now, except I saw a news item yesterday that said Nationwide, is Nationwide the second life insurer on the platform?
Well, we have over 20 insurance companies on the platform. Nationwide came on as a new member within it. They didn't come not on as an
Investor.
Right.
Yeah. Yeah. Okay. And the 20 would be, I mean, once you talk, if there's hardly 20 really big annuity issuers. I mean, would be the whole list, I guess.
Well, if you kind of add them all up, there's probably well over 50 companies that issue annuities of some kind. But yeah, if you were to look at, the top 80% of the business, it's probably done by 10 or 12 carriers.
Yeah. Yeah. Now, these folks, Barclays and these guys also create custom indices, don't they? Are they going to, are they not just investors and distribution partners, but also creators of the indexes?
Well, they could, yes. I mean, there certainly, as you've mentioned, there's what did you say, over 140 indexes. I've lost track trying to keep track of how many there are. But one of the benefits of the Simon system is the ability to understand how any index is likely to perform and how it has performed in the past, and therefore would likely perform in the future. So you can have an expectation as to what the outcome will be for the client, as opposed to just, boy, I have faith in the S&P 500, so I'll just go with that.
Okay, well, now you've jumped into the heart of our discussion today, which is about these indexes, and let's. Oh, these are the products. These are the annuity products. Okay, we before we jump into the meat of the batting order about indexes, let's just comment on these. These are the products. These are the insurance products that you have on the platform, and you sell them both on a commission or fee based level. But how does that work? Is it a Simon's not make how does it work with the money? Is that something that happens off Simon platform or on Simon platform?
So the main objective of Simon is to allow the advisors, once they've determined which product they're likely to recommend, or maybe which 2 or 3, to better understand the options within the product, particularly the investment options, to help them more efficiently figure out how to allocate the client's money. And so we actually started with index and structured annuities on the platform because those are the annuity products that are most similar to structured investments. They are the ones with the indexes that we have talked about today. We then moved into the fixed products, and yesterday, as a matter of fact, we launched our first variable annuity from Salmons on the platform, and we'll have many more coming in because they're all in the pipeline. But we've added to it from where we started simply because we heard the same comments from the distributors that we heard on structured investments. Is like, this is a great tool for fixed and index business, but we sell variable, we sell all these other products. So we need to have this cover all the product lines. And so therefore, that's what we have been building out. And we do offer on the platform, have the ability for advisors to look at both commission-based products and advisory products. And they can sort through the system, as we'll see, in order to be able to do that. So, but the objective is to give the advisor a platform for them to go to do the analytics on these products that they can't do today, or they're trying to do on their own.
Okay, well, let's look at some of the pages on the website where this assistance takes place. let's see. We'll come back to this.
Okay.
So here are, maybe you can add to this list. This is what I thought. I mean, there's so many things to consider. There's so many intermediate decisions when buying an annuity. Do you, how does Simon help people make these choices?
Yeah, so you were exactly right in your opening comments. There is all of these things are things they have to consider. And even within the crediting method, there are, and the indexes, they have to decide which index, which crediting method, what length, what various, protection they want if it's a structured annuity. I kind of think as structured annuities as basically a whole bunch of structured notes within one annuity contract.
Mm-hmm.
And how do you decide? Right. So you're right. I've got to first decide what carrier am I comfortable with? Who do I think is going to provide me the service I want? Which product? They might offer several products. Now you've got all the different credit methods. Do I want to have a 1-year term, 3-year term, 5-year term, 6-year term? Do I want to put a living benefit on it, which exists all over the place on index annuities, and now we're starting to see them on structured annuities? And what does that living benefit potentially do to my performance by adding those guarantees? All of these things are the advisors need to understand.
And yeah, it's kind of a daunting process. But it's fascinating that what you said about a lot of structured notes. In the investment business, we're used to having somebody buy a custom, single custom note, and you provide that service, right? But an annuity is, well, people used to think, people think of annuities as many different things, but now what's emerging is that these fixed and especially the structured index linked annuities, these are each product is a kind of supermarket of different investment paths.
Yeah, that's definitely true. I mean, there are structured annuities out there that literally have, but by the time you add up all of the different time periods, protection elements, indexes, et cetera, you have 40 to 50 choices to choose from.
Mm-hmm. I mean, that has been and advisors they have a kind of divided feelings about how they like all those choices, right?
Yeah, I've always, the IRI for years had advisor panels at their conferences. And the one theme that came out of it always was they wanted products that were less complex, but they loved all the choices. Advisors love choices, and we all love choices. I mean, I go to the grocery store, I can now choose between 20 different types of Oreos. But we all love choices. But now it's about how do you decide once you get the choices, and that's kind of what Simon was designed to do.
That is the challenge now when dealing with these new products.
Yep. And so I find this graphic, because this is an example as to what they have to look at. And I kind of actually look at it as though kind of from the bottom up, because I think what advisors are trying to do in looking at these structured annuities and any sort of risk managed solution is they first have to match up how much risk do I want to expose my client to? How much protection do I need? And that's kind of the first decision you have to make on this whole thing, as far as determining the length of time, et cetera. Because the longer I go out, the lower my risk of actually losing money over that time period. There's obviously a much higher probability of the index being down a year from now than there is 6 years from now. But also, the more protection I have, the less my upside is. So everything's a trade-off. And then I'm going to get different levels of risk versus reward for everything at the top, whether it be equities or international equities or commodities or real estate. All of this goes together in the decision. And I really don't know how an advisor on their own would be able to effectively and efficiently make these decisions.
Well, I mean, the rule of, what they have been doing, right, is instead of going through this methodically like this, don't they generally look at the crediting rates? That's the eye grabber.
Sure. Yeah. You're going to always start with, who's going to have the highest cap rate or participation rate, probably at the level of protection that you want. So again, they're probably starting with the level of protection, but once they've decided that, then it's often about who's got the highest rates.
Mm,
But a you know, a 40 or 50% participation rate on the S&P 500 is going to have a different result than a 40 or 50 participation rate on the Russell 2000, let alone on commodities or some other form of security. So all of that has to be considered.
mm. And a lot of people are fascinated by the uncapped strategies, and this was always an issue with picking fixed annuities because well, the uncapped is there. The uncapped, that's one of the main mysteries of these products. People look at it and say, well, I can get all of the index, you mean, and a buffer, and is it that simple?
Well, in a way, yes. So yes, obviously being able to tell the client your return is uncapped is a
Mhm.
very attractive thing to say and very appealing. But you always have to then ask uncapped versus what, right?
Mhm.
So most of the time, if you're going to see on an index annuity a uncapped strategy, it's going to be, particularly at these interest rates, if you can still find one, it's going to be on a volatility controlled index where the index itself is going to limit your returns. If I've got an index that's managing to a 5% volatility, well, okay, I can probably get an uncapped strategy, but even in the best of markets, that 5% vol managed index is probably not likely to earn much more than 10 or 12 or something to that
Mhm.
effect, depending on what the strategy is.
Mhm.
So, it's uncapped is great, but if you don't understand what the underlying economics are that allows the insurance company to offer an uncapped strategy, then you can find yourself in a position where the client might get a really good return relative to alternatives, but
Mhm.
it may not be what the client expected, because once they hear uncapped, and if they see the market goes up 35%, or you have a market like we had for the last year, they're going to
Mhm.
expect that they're going to get this great return. And
Mhm.
that may not be, it's in all likelihood not a possibility, depending on, how it's structured. That's
Right.
part of the challenge of all this.
Right. It's one thing to tell a person, to give a person a Ferrari and say, you can go as fast as you want. And another thing to give them, well, like one of the old ice cream trucks that I drove as a teenager that would not go more than 25 miles per hour. Uh, we were allowed to go as fast as we wanted.
Ah,
So uh, now, the market that you want exposure, this is expanding all the time. That's one interesting thing about these indices. There they have real estate, commodities, emerging markets, but their bonds are also certainly in some of the hybrid indexes, and the commodity levels include gold and other things. This range of exposure is growing, I think, practically every day.
yeah,
Uh,
no question, because as you can bring new carriers come out or new products come out, they've got to have their own wrinkle. It's got to be different. And so
mhm,
you still have many more different indexes and strategies on the structured investment side than you do on the structured annuity side.
mhm,
But if history is an indication, that will change over time as more products come out and demand picks up. There's going to be all these niche indexes out there and
mhm,
niche strategies.
mhm,
So it's just going to get more complex. I mean, to your point that you made at the beginning, if you look at the structured annuities that then AXA, now Equitable, brought out
mhm,
originally, and you compare it to what's out there today, it's night and day. And
mhm.
we're only about 10 years into this development. So I can't even imagine 5 to 10 years from now what this will look like.
Mhm. Now we talked about the crediting period, and there's a trade-off there that some of these crediting methods, if you go out 6 years, they'll give you an upside limit of I've seen 140, 150% of the S&P if you buy a volatility controlled S&P. Now, I should point out this downside protection. Can you, for those who are not familiar with how the downside protection work, could you just briefly distinguish between what these percentages mean in terms of either a floor or a buffer?
Yeah, so for the most part, there's two means of downside protection. One is going to be a buffer, and that's really what this chart shows here, where the insurance company absorbs the first certain percentage of the loss. And so typically, there's designs out there with a 10, 15, and it's shown here 20 or 30% buffer. And the difference would be that if I take the 10% buffer, then if the index is down over whatever period I have by no more than 10%, I'm not going to have a loss. But if it's down 20, then I'm going to have a 10% loss. And therefore, if I go to the 30% buffer, the only way I lose money is if the index is down more than 30%. Now, that doesn't happen very often, even on a 1-year period. Probably doesn't happen at all on a 6-year period. But at the same time, to provide that much protection, you're not going to have hardly any upside. So it becomes a balancing act. Now, the opposite approach is a floor, which basically says that this is the most you can lose. So if I have a 10% floor, it's kind of the opposite of a buffer, that you're going to incur the first 10% of any drop in the index, but anything beyond the 10%, you won't have any loss on. Typically, you only have 10 or 15% floors. I don't think I've seen a design of more than that. The buffers go much higher, but the floors themselves are typically just 10 to 15%.
Sure, sure. And okay, well, let's move on to the indexes. Now, this is a sort of an exhaustive list of all the topics we could go into if we drill down into the issue of how do you pick an index, but I'd rather really actually hear more about how Simon helps you sort through all of these things and evaluates them. And I wonder if let's move into some of the slides that we've got from tell me if
Well, go back one.
Let's go through the process for, do you evaluate the indexes for people? Do you educate people, or do you just say, if you pick this, here's your outcome, or if you pick that? How involved is this as an educational tool, or is it like push the button and you get an answer?
So this is the first page. Once I've selected annuities, I'm going to go into the annuity part of Simon. This is the landing page you're going to come to. And there's essentially 3 parts to Simon. There's the Learning Center, where we have all of the training modules that exist within Simon. The Marketplace is where all the products exist and where all the product analytics. So that's where I'm going to go. Once I've got all the training done, I'm going to go into there and I'm going to begin to look at individual products to begin to understand better how they work and how they performed in the past and how they're likely to perform in the future. And the Life Cycle Portal is the third piece of Simon. And this is where an advisor has the ability to look at their entire book of annuity business. Essentially, what we do here is that we take the DTCC file feeds that the distributors get, and we take all of that information and put it together in one place. So for the first time, an advisor can see every policy that they have, that they're the agent of record on, and information on each policy. So we'll start here, if you move to the next slide, to the Learning Center, because that's kind of the progression. And you see there's certain different parts to it. Now, this is the part that is the general training. This is where insurance companies can put individual training modules. No, I'm sorry. This is the NAIC training. So one of the issues that advisors have is that the insurance companies are required by state insurance law to verify that the advisors are adequately trained on the product. And the industry has interpreted that to mean that you have to take a test on any product before you can recommend it. And a challenge becomes knowing which products I've taken the test for, Sometimes the test has to be updated because the product changed. I might have to retake it. Where do I go to take it? Have I done it before? Have I not? How do I get it? Simon brings all that to one place. So we currently have, I believe it's 25 insurance companies have their NAIC training on it. You can see there's 217 different product manual or training sessions. And it's really easy. I just find the product that I want. I can search for it. And then I hit start and I walk right through it. And then we're completely online with the carriers. So as soon as I'm done, the carrier knows I'm done. I know I'm done. The back office of my distributor knows I'm done. And I can now move on. And so we've eliminated an entire huge reason that there's a not in good order requirement because the advisor inadvertently missed this initial step.
Mhm.
So if you want to move on to the next slide. So in addition to that, we have built in our own training modules. And so they're basically 1 to 3 minute videos on different aspects of annuities. So you can see the first one is a fixed index annuities 101. It just gives an overview. And then there's one on each crediting strategy, et cetera. And we filed many of these with FINRA and gotten clean letters. So where you see, for our sharing with investors, that means advisors literally can let their clients look at that. So when they're explaining a particular type of annuity and they want the advisor or the client to have a little bit better understand how it works, they can just sit down and let the client watch the video. And finally, we've got a section for general training that allows insurance companies to, quite frankly, put any training they want. And so we've got some carriers who have different training modules on specific aspects of their product. It's not required to sell it, but it's a good overview. And so we host that for them as well. So once I'm done with the training, if I now move on to the next slide, okay, I go into the marketplace. And since the topic today is structured annuities, this is the screen that we would look at within the marketplace. As you can see, we currently have, if I'm looking at my screen right, 23 different structured annuity contracts within the marketplace. We got most of the current main players within the space. And I have a list now of all the products and some basic information as to what type of protection items it has, how long the surrender charge is. You see on the right-hand screen, the first one says fee-based, the next one says commission-based. So if I just want to look at fee-based products, I can sort through that and just click on the tab at the top, select fee-based, and I will only see those products. It also filters out, I have to put in what state I'm in. So we'll filter out and make sure I'm only seeing the products that are available in whatever state I'm selling the annuity. So moving on. Once I've chosen the annuity, the challenge now becomes, well, how do I allocate it? And so what we do is we plot out an efficient frontier that's based on historical data of all of the options that are available within a particular product. So with this particular product, it's, we're looking at all of these options. You see there's an S&P 500 index, there's a Invesco QQQ, there's the MSCI, there's a Russell 2000. And within that, there's different protection limits, et cetera. And so we look at all of those options, the past performance of all of them, and we plot out this efficient frontier that maps the annualized return versus the volatility and allows the advisor can move up and down this line, and wherever the dot is, it's going to have a recommended allocation. And so you see right here in this example that this allocation, based on historical 15 years worth of data, we have to have at least 10 years in order to use this, include an index. If you had this allocation of 59% in the QQQ 1 year point to point, 30% in the 3 year point to point, et cetera, you would expect to get an annualized return of 10% with a volatility of 6.11. And so, if that's the client doesn't want that much volatility, you simply move down the curve and it will give you a new suggestion based on that. So that the advisor has the ability now to get an understanding as to how to do it. Now, I'm sure no advisor is going to come up with this type of allocation on their own. And if they're ever asked, well, how did you come up with this? Now you've got all of the evidence you need for Reg BI or any other suitability tool to say that this is how I came up with this, what the expectations were.
This seems phenomenally complicated.
Behind the scenes, it's phenomenally complicated. And I'm so glad that I don't have to do anything to actually make this a reality, that it's really all, we've got all these great tech people that can do all this, but from a
Mhm,
user point of view, it's phenomenally easy to use.
mhm. Now, we have to point out that not all of these indexes are going to have, some of these back tests are kind of, the indexes don't go back 15 years necessarily.
Yeah, that's particularly true in the index annuity space, where you've got a lot more different index choices, a lot more volatility controlled, uniquely designed indexes, almost for index annuities. It's not so true to date in the structured annuity space. That for the most part, the carriers are using indexes that have been around for a while. I expect
Mhm.
that'll change over time, but that's the way it is today. So
Well,
if you want to,
Nationwide, I know does have, they do have a structured index, they do have a RILA, the registered index linked annuity with some of the newer uh, dynamically rebalanced indexes.
yep, and
So
that continued, yep,
that's coming.
yep.
And this is, I assume that this chart, that this gizmo takes into account, what crediting method you've chosen and what term you've chosen, and it does all that on the fly.
Yes, this is all based on today's interest rates. Now, it is using past performance of the index, but it's using today's cap rates, participation rates for this particular product.
Mm-hmm. Mm-hmm. And then do you do you cover the whole range of indexes that are available in the products on the platform?
We do, yes. Now, in order for it to be included in the efficient frontier, we do have to have the 10 years worth of data, but the information is still there. They can still allocate to an index that is not part of this. They're just not gonna be able to do as much of the analytics. So if you want to move to
So
the,
the index itself has to have 10 years of, it has to be a 10-year-old index?
we need to have at least 10 years of actual or back tested data.
Oh, or back, so it can be virtual.
Yep.
Okay. Anything else we need to,
Now, if you want to move on to the next one.
okay.
So here's an example. All right. So this is the Prudential FlexGuard product, right? And so let's just look at, for an example, their 3-year. So when I go into this particular product, before I actually do the allocation, I'm going to actually see all the current interest rates when they went into effect. If they're going to be changing soon, we will list that as well. But you can see with the 3-year point to point, I've got a, and apologize, it's a little blurry from my screen, but I've got a, uncapped 3-year point to point. To your point, you talked about, earlier you talked about the fact that there's uncapped options out there with a 10% buffer. And I've got, or do I choose between the 27% cap, which means that's the most I can get over a 3-year period with a higher buffer. Right now, to your point, everybody wants uncapped, but in order to get that uncapped, you have to ask 2 questions. First question is, what does that really mean? How much could I likely get over a 3-year? And the second is, will it give me enough protection on the downside given my client's risk profile? So Simon allows them to look at each index individually through what we call our index back testing. So if you want to move to the next screen, and this is a picture of, this is that same product. It's the Prudential product. And now I'm going to look first at the 3-year point to point on the S&P 500, uncapped with a 10% buffer. All right. So the first thing you see in the underneath that is it looks at what it did for the last 3 years. So for the last 3 years, from May 18th, when we did this screenshot, the index was up 52%. My strategy is uncapped, so that's what I would have gotten. And you can actually change that time period and look at any 3-year period you want. But if you then go over to the right-hand side, now we've got 20 years, the last 20 years worth of data. And what we literally look at here is we look at every 3-year period of the S&P 500 from that May date of 2001 through that May date in 2004 would be one. The next day to the day after would be another 3-year period, et cetera. So there's, I don't know how many, lots of 3-year periods.
Mhm.
Over that 3 years, over all those 20-year period, looking at every 3-year period, the best you would have ever returned is 102%. So when we
Mhm.
say uncapped, that means probably the best, in the best of all worlds, the client could potentially double their money, which I'm sure they'd be happy with, right? The average though is, I'm sorry, the font's small, so it looks like 20% to me. I'm gonna see if I can. So 20.56%, right? The worst I would have ever done, even after the 10% buffer, is negative 36%.
Mhm.
So then the question becomes, well, what's the likelihood of these events? Well, 71% of the time over a 3-year period, the client would have gotten a positive rate of return.
Mhm.
6.65% of the time, looking at all those periods, the client's return, the index would have been down between 0 and negative 10, which
Mhm.
means I would have gotten 0. And then 22% of the time, I would have gotten a negative return. So this allows the advisor to ask the first question that, yeah, uncapped is great. You would expect to get about a 20% rate of return over that 3-year period. You could get, in the best of all worlds, maybe double your money, but you got
Mhm.
about a 1 in 5 chance of actually losing money. How do
Mhm.
you feel about that, right? Is that enough? Well, let's go to the next screen and we can look at the 20% buffer. Now I'm limiting myself to 27% cap, okay? So I go back to the right-hand side. Obviously, the best I could ever do is 27% because that's my cap. So you're not gonna get better than that. I would have averaged 15. The previous one was 20, so I'm clearly giving up some upside. My downside is now only negative 26 because I pick up an extra 10% buffer. But my chances of getting negative return have gone from 22% down to just under 17. And basically I've shifted more into the 0. I'm still gonna have the same percentage of the positive because if it's up, both strategies earn money. So the
Mhm.
advisor can then ask themselves, all right, am I willing to give up that much upside and reduce my client's expected 3-year return from 20% down to like 15
Mhm.
in order to reduce the chances of me getting a negative or the client getting a negative return by about 5 percentage points? You know, I'm not here to say what the right answer is, but
Mhm.
without this data, I don't know how you begin to answer the question at all.
Mhm.
And this is really the power of what Simon delivers is giving the data and the information that the advisor needs to make better decisions and trade-offs on behalf of the client.
Mhm. And then now the advisor is going to rely on this to probably to pick one. He's not going to overwhelm his
Correct.
client with
Yeah.
making these choices because they won't be able to.
Right. And and for the client, if the advisor concludes that 16% chance is too much for the client,
Mhm.
well, one option would be you could go to an index annuity where the chance is 0.
Mhm.
Or your other option is you just have to go into a longer point-to-point strategy or 5 or 6 year,
Mhm.
thereby reducing the amount of volatility over the time frame, right?
Mhm.
The trade-off there is now the client doesn't get interest until the end of that period. So instead of waiting 3 years for interest, now they got to wait 5 and 6 years. So maybe you put so what some advisors do, they put some into a 1 year and some into a 6 year. So they're
Mhm.
likely to get some interest each year, but more later. But again, without this information and data, how do you come up with a strategy? How do you come up with a solution?
Mhm.
And to your point, as these products get more and more complex, it's just going to get worse.
Mhm.
And you literally, I'm obviously biased as given my role at Simon, but I just don't know how an advisor would be able to recommend a structured annuity uh, without information and data like this.
Mhm. Well, I think that for it to make sense to consider these products, and to undergo and to put in the amount of effort that you need to do to make some of these decisions, you can't. I mean, what I've learned from writing about annuities for all these years is that you really have to focus on the outcome or the bracketed outcome, and that's what you're buying or not buying. This is not. I mean, and annuities are not an investment. If you want an investment, I mean, you're better off going straight to the ETF or the mutual fund. But if you're looking for a bracketed outcome, then that's why you go to these lengths of studying the numbers, right? I mean, it's basically a different kind of product for a different kind of solution. It's not the complexity for its own sake.
Yeah, that's correct. And I kind of look at it this way, is that there's this the reason that structured annuity sales have been increasing so much is twofold. Their first is, as interest rates have fallen, advisors and clients are looking for ways that they can get a decent return with some downside protection.
Mhm.
And now that probably the likely return each year on an index annuity is closer to 3.5%, given today's interest rates, a lot of that money is now shifting into the structured annuity side, where basically I'll pick a choice that has a small probability of a loss, but I get more upside as a result of
Mhm.
that.
Mhm.
And in the other part is that, well, I'm a classic example, right? I'm now cross the age of 60, and I don't want to go backwards. I can't afford at this stage. I'm not going to be working enough years to afford to see my portfolio go down, 30% one more time, like it did in the tech crash, or it did in 2007 through 2009. And so there's this huge need for products, whether it be structured investments or annuities, that give me the protection I need with still some upside. So you're correct. This isn't so much an investment as much it's a way to protect the portfolio
Mhm.
from an adverse event for somebody who just can't or is not willing to go through that again.
Mhm. Yeah, the annuities are about transferring investment risk to an insurance company, not about taking insurance risk. You wouldn't want to put all these baffles and buffers if you were interested in going after risk and getting the full risk and reward. This is the reason I'm dwelling on this is kind of a hobby horse, is that people have to understand that annuities, if you look at them as investments, they just look like very expensive investments,
Right.
but they're not. They're insurance. They're risk transfer away from you, and you're paying someone to take that risk from you, and or share that risk with you.
Correct. Yeah, and for years that was all done through, asset allocation and
Hmm.
rebalancing and all that, and that all worked great when interest rates were much higher. And the 40% of my portfolio, I could actually get a decent return. And for that matter, I could actually get a return on cash.
Hmm.
And then as interest rates fell, it still worked great because now I got gains on the bonds on top of it. But now that
Hmm.
where we're at, the traditional 60-40 portfolio, there's a growing wisdom or belief out there it no longer works at these interest rates. And so you got to find a different way. And that's really where annuities fit. That we see money moving into something like a structured annuity, whether it be as an alternative to other fixed income, or maybe the client has gotten overweighted in equities because of the run in the market. And so
Hmm.
rather than taking money out of the equities and put it into fixed income, you take it out of equities and you put it into a structured annuity. So
Hmm.
it's filling that fixed income part of the portfolio.
Hmm.
Structured investments do the same thing.
Yeah. Well, from what I hear, the expectations from these products is the reasonable expectation is to get about 2% more than the corporate bond rate.
It'll depend entirely on how much downside protection you want. Clearly, if I'm going to go with the uncapped protection or uncapped upside, and I'm
Hmm.
willing to take just a 10% buffer, um,
Hmm.
I can do really well. And that's another reason these products have become popular is in the market we've had since 2009, any sort of structured investment has done well. If
Hmm.
particularly if you went out at least a 3-year time period, it's just kind of let the index work for you. It's worked really well, and the clients are happy with what they've gotten.
Hmm. Well, the products only do well if the equity markets do well, right?
Yes, that's correct. Yeah.
Yeah. So to me, that's always been kind of a kind of a not a little bit of a contradiction, that if you buy these products, you must believe that the equity markets are going to go up. But if you believe that the equity markets are going to go up, why buy an insurance product? So,
Well, because I don't know, so
right.
right. If somebody would have suggested to all of us back in April of last year that we were going to, the markets would double over the next 12 months, I would think there would be a lot of skeptics about that statement. And so even if you got somebody to buy into it, they would say, well, yeah, but what if? Well, this is designed to cover the what if.
Yes, I mean, people as they move, as they cross into retirement, they need some sleep easy protection.
Correct.
So is
And
there any? We're going to go to Q&A and go ahead.
Yeah, I'll just comment on this quickly because I want to make sure we get to Q&A. But this is the life cycle portal and what it would look like, where an advisor is able to go in, and you can see in this particular case, this is just a sample. An advisor might have a $204 million of annuities. They got 24 clients. They got 14 different products. And we're going to bring together all of this into one spot. So all within Simon, they will be able to see all their policies. And it will also tell them if there's an event coming up with that, any individual policy they need to know about, like a surrender charge ending, or a strategy coming up for a renewal, or an interest rate coming up for renewal. All of that is going to be presented to them in one place. So the goal is that, hey, you can manage all of your annuity book from Simon.
And who's paying for all of this?
So the Simon is all funded by the insurance companies, because they have seen how this can make the world simpler. And we all understand, anybody who's been in the annuity business for any length of time knows that the biggest challenge on the annuity space is the complexity of doing the business. And so the insurance companies are so far being willing to vote with their money that we can be part of the solution with that.
Well, we have about 9 minutes here for questions. We have a list of about 10 questions here. Let me look at them. First question was, someone heard you refer to the percentage of industry structured sales that goes through Simon now. You mentioned a number, but they missed it.
Yeah, so what I mentioned was in the structured investment side, it's between 40 and 50%. We're just getting started on the annuity side. So today, it's a relatively small percentage. It's probably, if you exclude the group annuity business, like the 403B business or so, we're probably getting about 2.5 to 3% of the total annuity industry business through Simon. But it's every month, it's a bigger number.
Now, there is a question. It seems like most RILA structures are buffers. Are any being sold with floors?
Yes. So most of them are buffers, but yes, there are one that have floors that are designed for that client who needs to know they can't lose as much, more than a certain amount. And like I said, most of them is like a 10% floor. There are a couple, I believe, 15% floors, but for the most part, for that client, as soon as you go beyond a 10 or 15% floor, it becomes an unattractive option for them, because they're like, well, I don't want to lose more than 10%. I'm willing to do that. The problem, I wouldn't say the problem, the trade-off on the floor side is you're not going to have the same amount of upside because you're getting more protection against the extreme, right? You're probably likely to get a negative number more often than in a buffer, but you're protecting yourself from those, Marches of 2020 as an example. So but again, they're definitely out there.
Yeah, well, the way it was explained to me, it was that you get a bigger options budget by selling the protection beyond 10% than you do from keeping that protection or selling the protection up to 10%. And that, so they do that. It's because when you said it, you get more upside that way, it's because behind the scenes, it's changing the cost of the options.
That's correct.
And the cost of the options is what determines, if it's not obvious, we have to make clear that there is no direct investment in the indexes in these products. You're taking the earnings from the general account of the insurance company that they get on your premium, and they're applying part of that to the purchase of options on the indexes.
That's correct.
Okay. Is Simon monitoring FIAs and their indices as well? I think,
Yes.
right, yeah.
Yeah, and the reason I demo the structured annuity piece is because that was the major topic today. But once you create the possibility with a structured annuity that you can actually lose money, the analytics become even more important. You know, the worst thing I do on an index annuity, if I make a bad allocation, is that I might cost the client some upside, but it's not going to create a situation where the client's going to lose money.
Question from Jeremy Alexander of Beacon Research. Is this analysis limited to a single product? I guess he means one at a time, or can you run it across all products to determine the best option?
Yeah, to this point, we have not built the analytics to basically put in various aspects or requirements, and then all of a sudden it starts screening all the products out there and comes back and says, here's your best one, or here's your best two or three. Where we really, there are some products, some solutions out there that do that. Where we really pick up this whole equation is once you've pretty much decided this is the one or two products I'm going to recommend, we're going to make it possible for you to more effectively and efficiently use that. But that is the biggest thing our clients ask us to build next. So we'll see somewhere down the road if we start heading that road.
Right. There's no end to the software. I mean, no matter how much software you have, there's always going to be another layer. Now,
there's not a week that goes by that we don't have a client ask us, can you do the following?
Now, is there any advantage financially to one of these buffered products within an insurance product versus buying the structured ETF? I think they're referring to like a defined outcome fund. Well, the difference is the tax deferral, right? I mean, that would be the most obvious one.
That's certainly going to be the most obvious, is that you get the tax deferral that comes with the annuity. You know, it is you always, whether you're looking at an annuity, structured annuity versus a structured ETF or a structured note, it's a longer hold. You have to assume it's a buy and hold for the client. That once they're kind of in the annuity side, they're probably going to stay there until they decide they need the money.
Is this is your research and education space limited to advisors, or could an advisor tell his client to, you know, if you want to learn more, go to Simon and log on and read about it?
As we develop all of these different, our own training modules, we're filing them with FINRA. So our goal is to have an entire library of training material or little videos, or more like informational pieces that advisors can use with their clients.
Sure. There's a lot of different kinds of compliance rules that go into anything that goes to individuals versus. Can you address the problem of constraining an index in order to look good in a back-tested environment, thereby preventing an index from optimal performance moving forward?
Well, I think what this question is trying to get to is basically, you know, the whole question of how accurate is back testing. You know, I think one of the statements in the article that you published yesterday was, you know, you can make any back testing look good depending on what assumptions you make, et cetera. So, you know, that there is, if for no other reason, because if I'm doing back testing on the, let's say the last 10 years, well, you know, it was a 10-year period of declining interest rates. We're in a much different world today. And so but you got to start somewhere. You've got to utilize something. And so as imperfect as back testing can be, you got to have some sort of analytics in order to do that. Obviously, like everybody, like every other organization, we prefer to have actual data on the index as opposed to back tested data. And that'll be something that over time, as these and indexes get more and more history, we'll be able to continue to refine and get better analytics on, but you got to start someplace.
Mhm. How about one listener says this is great data for buying annuities. How do you go about getting the data for in-force products?
So when we get to, as we roll out the life cycle portal, one of the things that we will be able to do is that, let's say you've got an index or structured annuity that has a strategy that's coming up for renewal. You'll be able to click on that particular policy and it will automatically then have the analytics run to
Mhm.
help you reallocate now that those have come due. And so that's part of what we're building and what we're trying to give the advisors.
Okay. Now, how can an individual producer gain access to the platform?
So we set up agreements with distributors, and so a Raymond James, an LPL, a Cetera, et cetera, are as examples of some of our clients, and then they make it available to their particular advisors. We don't currently have a means for, let's say, an independent agent out there to get a license to utilize Simon. So it all has to go through some sort of main distributor firm.
Mhm. Now, can you advise what the adoption is among advisors, and is there better adoption among annuities advisors in particular channels, such as the FMOs compared with the independent broker dealers? And what is your going forward expectation?
So it's with any technology that I've seen introduced within the financial service space, and particularly in the annuity space, it takes time for advisors to adopt it, to utilize new habits.
Mm-hmm.
So part of it is just getting them exposed to it, doing webinars like this, making sure the wholesalers of the insurance companies that we work with understand how to use it, et cetera. So we're definitely getting there and getting more and more adoption all the time. We've got
Mm-hmm.
way more adoption on the structured investment side, simply because that piece of the platform is now 3 or 4 years old. The annuity space, if we go back even a year, we really only had one distributor on it. So now we've got somewhere around 13 distributors with more in the pipeline. And we've also needed to add more insurance carriers. So as we get more and more insurance carriers on the platform, more and more products, we obviously get more and more adoption. But in a typical firm, we will probably see somewhere around 10% of their total advisors, which would be probably 25% of their annuity producers, go in and utilize Simon's marketplace in any given month.
Mm-hmm. Okay, thank you, Scott. We've run out of time here. We're running a little bit over. I want to thank Scott for helping us delve into this overall subject of indexed annuities and into the Simon platform in particular. It's certainly a lot to cover in one session. I'll put in a plug for my publication last week, and on June 3rd and on June 10th, we have been running stories about the indexes in the annuities, and we have quotes from various people about their own experience with it. So I urge you to go to retirementincomejournal.com and look at last week's and this week's stories. Once again, thank you to Scott. Thank you to, we had very good turnout for this, so which is wonderful to see for an increasingly important product category. And thank you all for listening and watching. And I hope to see you at our next webinar, which will be in 2 weeks with the index standard, which also works on evaluations of indexes. And so we'll see you, I hope, in 2 weeks. Thanks, Scott, and
Thank you,
goodbye,
Kerry. I
Terry.
enjoyed it. Have a great weekend.